Welcome to the Top of Mind podcast from Altos Research. This is the show where we talk to real estate industry insiders and experts about the trends shaping the market today. Enjoy the show. Mike Simonsen here. Thanks for joining me today. Welcome to the Top of Mind podcast. This is where I talk to the smartest leaders, thinkers, doers in the real estate industry. For a few years, we've been sharing the latest Altos Research market data every week in our weekly video series. With the Top of Mind podcast, we're looking to add more context to the discussion about what's happening in the market, what's going to happen from the leaders in the industry. Every week, of course, Altos Research tracks every home for sale in the country, all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. People desperately need to know what's happening right now in the housing market. The market was frozen so solid last fall, and then suddenly the landscape is changing again. So everybody's worried about what might happen in 2023. So if you need to communicate about this market with your clients, your buyers and sellers, go to altosresearch.com and book a free consult with our team, and you can learn about how to use market data in your business. But speaking of data and informing the buyers and sellers and the participants in the real estate industry, I have a terrific guest today, Selma Hepp.
Hi.
Selma is the Chief Economist for CoreLogic, the largest provider of advanced property and ownership information, analytics, and data-enabled services. Selma leads the economics team, which is responsible for analyzing, interpreting, and forecasting housing and economic trends in real estate and mortgage and insurance. We're going to talk about all of those things today. Selma has had senior economist roles at PAC Union, at Trulia, the California Association of Realtors, and NAR, and was also a special assistant, research assistant at U.S. Department of Housing and Urban Development. She frequently appears in the media commenting on housing, and she also received the Housing Wire Women of Influence Award in 2022. Selma is one of the top experts on what's happening in the housing economy right now. CoreLogic has remarkable data to build on, and so I am very excited to talk to her. Selma, welcome.
Thank you, Mike. Thanks so much for having me.
Great. It's really great. We haven't met before. We've worked with friends at CoreLogic for a bunch of years and truly at all the places you've been, but you and I haven't had spent any time yet. So this is really terrific for me.
Yeah, I agree. I mean, I see your stuff on social media all the time, and so I'm glad that we're finally connecting here.
Great. And so, let's before we dive into like the data and forecasting and all those things, tell me a little bit about you and your background. Like, how did you develop your expertise and get to be as prominent as you are in the industry?
Yeah, I mean, life sometimes takes you in funny directions, right? It was never my plan to be doing this, but my career in real estate actually started as a real estate agent. This was back in 2004. I was a real estate agent in Tampa, Florida. It was after I finished my master's degree in economics from SUNY Buffalo, and living in Buffalo, New York, I had to move down to Florida to warm up. And so I got a real estate license there, and I worked there for a little while. So that was my entry into the market. But then I decided I really actually wanted to get my PhD, and I moved up back halfway to Washington, D.C. I went to University of Maryland. As a part of my studies, I did a special research assistant position at HUD. And there I dwelled into a lot of housing data that really allowed me to see all the opportunities that there are. I mean, I always had passion for how cities grow and be what they are. I come from Europe, and I coming to US, I was trying to understand sort of why are there not more sidewalks in the US, or why do people spend more time on the streets, for example, in Europe than they do in US? But then since then, a lot of things have changed. And as part of my dissertation, I sort of looked what's the spatial distribution of households within metropolitan areas. And that was something that was very relevant at the turn of the millennium in year 2000, because prior to that, a lot of people were moving to suburbs, and then starting in early 2000s, they started coming back into the cities. And so that was a really interesting time to study housing. And now it's similar, interesting again, because people are now moving back out to suburban areas again. But anyway, so that's sort of where my passion comes from for housing data. But then along the way, I had a number of positions where I further learned to appreciate how to think about housing markets. You mentioned in my bio, I worked for the National Association of Realtors, California Association of Realtors. I worked for Pacific Union, was a large brokerage in California. I worked for Trulia, and now I've been with CoreLogic for last about I think it's 3 years. Losing track of time, but yeah, 3 years. And I just really now appreciate having all this data at my fingertips to really dive deep and understand, and sort of allows me to see turning points as soon as they're happening in the housing market. So when we saw housing market turning in the spring of last year, we were able to see that very soon in our data. So it's pretty exciting. I love what I do.
Yeah, that's great. That's a really terrific background, and I didn't know about that about you, but the having the experience as having sold real estate. Like, I've never sold real estate. I'm a data guy. Like, I'm a Silicon Valley's data software guy
Mhm.
who happened to buy an overpriced Silicon Valley house with a giant mortgage when he was 30 years old, right? Like, it's so I had to understand those things. But actually having done the transaction is like that's a unique viewpoint for a lot of economists.
Yeah,
Does it change how you interpret data sometimes?
I think it helps a lot. I mean, it's particular because I was in Florida in 2004, so leading up to the big housing crash, and so I love to say I saw it coming, but all of us like to say that. But indeed, like I feel like when I was in the middle of it, and when I saw how easy it was to get mortgages, and just some of the games at the time that were being played, and getting multiple mortgages for one person. It was just there were a lot of signs out there that the market was, there was a lot of exuberance in the market, and something was about to go wrong really soon.
Yeah. I mean, I could say very quite confidently that I saw it happening and coming. What I didn't know was what to do about it,
Hmm.
right? How do you act at that point? And that was the harder thing to do. Is like, you can see, like, this is nuts, and we could see it in our data. We could see it in a bunch of different places, but it was like, but the actual acting on it was different. Like, do you sell your house? Do you
Right.
not? Like, all of those things were kind of interesting
Mhm.
approach, and it actually turns into you know, where we are right now and the turning point we had last year. We had the pandemic boom, and we could see we could you could see in the beginning of the year a slowdown was coming. It hit really hard in the second half of the year, and now we're in a space where it's like, do we see it coming still? And what do we do about it? What's your view for, like, what the market's doing right now?
Well, you mentioned earlier, market is frozen in many ways. I think it's very challenging out there. I think it's very challenging for real estate agents, for mortgage lenders, even for potential home buyers. But as you mentioned, there's some defrosting. There are some signs of defrosting. I think mortgage rates coming down was a huge sort of boost to confidence, or at least boost that we desperately needed. Unfortunately, mortgage rates are moving in the wrong direction again. But there's two sides to the story, right? I mean, it just the persistence of inflation suggests that we, as U.S. consumers, are really strong. There is strong job creation out there. People have a lot of, still have some savings. They are, their debt service is really low compared to we were even prior to the pandemic, or, prior to even for many years when you look back. So U.S. consumer is in a really good position, but that makes it very difficult to defrost this current housing market situation. And then on the other hand, I think with the big challenge is that the record low mortgage rates that we saw during the pandemic locked in a lot of potential home sellers. And so they're really contending with this fact of, giving up that mortgage rate and moving somewhere with a high, where they would have to use a higher mortgage rate and pay much higher home price. And then, for potential home buyers, it's the situation of, do home prices go down further? There's a lot of negative headlines out there about where home prices are heading, and then, expectations of recession, and then also just, not being able to afford for many. And then on the other hand, it's this like feeding, this chicken and egg situation of inventory. Sellers don't want to sell, and buyers are waiting for more inventory because, there's not much out there right now. So it's a challenging environment. But like I said, again, I think some signs of defrosting are there, and I think we're going to see more of that as we come into spring home buying season.
Okay, so you think we're going to see more defrosting as we do see some activity, and we've talked about it. We talk about it a lot. Like there are definitely signs significantly improvement over November and December
Yeah.
happening this year, and you think we're going to continue that like like that defrosting, so to speak, for maybe the next quarter.
Yeah, I mean, I think it a lot depends on mortgage rates. I think we've seen how responsive buyers are to declining mortgage rates. So if there's, if we can hopefully turn back to the trend now back to, some decline again in mortgage rates, I think it's very promising for the housing market. The other thing is, I think the frosting naturally also comes as there is seasonality is a function of seasonality right now, because we're entering spring home buying season. I think one unique opportunity right now for buyers is that there is not as much competition as it was at this time last year. So for potential home buyers out there, they may be in fact able to lock in, to lock in that contract, where last year, there were so many multiple biddings. There was home exceedingly selling over the home asking price. And so it was a very, very challenging environment. I think it's a little bit less challenging for those who are able to buy. And I think, I'm more an optimist when it comes to things. And so I do think that I do see opportunities there.
Great. Well, I mean, there's so many things I want to tackle here, but the home buyers having less competition now, I think, is an interesting thing that to note. And I've thought about it in terms of the first time home buyer,
Yeah.
where those folks have been just getting beaten up
Yeah.
in the buying process over the last several years. And right now, because they're not selling another house with a 3% mortgage first, they're just buying the house they're buying. And so it's like maybe there's finally some opportunity there for those folks this year.
No, absolutely. I agree with that. And we already see that in our data. So in our mortgage application data, we see the share of first-time home buyer increasing again, because those secondary or move-up buyers are pulling out of the market, and potentially, there's been a lot of discussion around investor activity. Some of the institutional investors may be pulling slightly back out of the market, and so I think the opportunities for first-time buyers are there more now than they were last year.
I love that you can see that in your data, so it's not just Mike's hypothesis floating around. And so, is it a significant move in the percentage of first time home buyers that's happening this spring?
It's a couple percentage points. Yeah, I mean, it's
Okay.
it's the share of first-time home buyers actually peaked, at least over last few years in early 2021 when mortgage rates hit record lows. But then has been declining since. So to see that increase again since last summer, I think that's a positive change in the trend.
That's yeah, for sure. That's really great, and I'm glad that we can see it in the data. That's really terrific. Let's talk about rates for a second. So it's now February, late February, when we're recording. I think this will go out maybe March 1 when we get out. But rates had been declining since like early November, I think, and then but then some strong economic data and then the 10-year started climbing and mortgage rates went from like 6 to almost 7.
Mhm.
um, Tell me about what you think about rates. Let me just leave it there. Tell me what you think about rates and the market.
Yeah, I mean, honestly, forecasting mortgage rates is one of the most unfulfilling parts of my job because you're inevitably, more than 50% time wrong.
Yeah.
General direction, right? And, general direction last year, we know mortgage rates were going to go up, but, I don't think a lot of folks were expecting mortgages to go beyond 7%, which at some points in time they did do too. So, in general, expectation is for mortgage rates to do come down, and this is despite of what the Federal Reserve's actions are. Is because there's been the increase in mortgage spread rate between treasuries and mortgage rates because of these uncertainties around what the impact of the Federal Reserve's actions are going to be on the economy. And so we are now seeing, maybe not, recession yet, some talk of soft landing, at least over the next year. And I think that will make investors feel a little bit more comfortable. And so we do expect mortgage rates to normalize. And what that means is, historically, the spread is about 107 basis points. That spread went up to, 250, 300 basis points at the end of last year. So, potentially if we see that the normalization of spread coming back to 170 basis points, we'll see mortgage rates coming down. And I think that's generally what most folks that do forecast mortgage rates expect. Maybe not necessarily this quarter, but, later down in the year. I think I was a little bit more optimistic about mortgage rates coming to closer to 5.5% before the last two economic reports came out, the job report and the inflation report. But I mean, I think still, even with higher fives, I think we could have better housing market than certainly what we had at the end of 2022.
Yeah, I mean, if we're in the fives, it sure seems like people are ready to buy pretty quickly there.
Yeah, yeah.
It seems like the demand is there in the fives.
Right. No, and I think, people, there are buyers out there. I think if what we also see in the data is if the property is priced right and it shows well, meaning that it's not, a fixer upper that needs a whole lot of work and then it's overpriced. Buyers are there, and buyers will pay the asking price, even in areas that have seen home prices decline, like Bay Area. It's been one of the top metropolitan areas with largest declines in home pricing since that peak of last year. But even in the Bay Area, we do see buyers, lurking out there and certainly buying properties that are priced right.
Yeah, I think that's a really interesting key. And we track, for example, the percentage of homes with price reductions around the country, and we watched that skyrocket last summer when the market cooled, and this year it's been dropping pretty dramatically.
Yeah.
As buyers are out there, as long as the home is priced right, so sellers have a little bit better expectations, and when they do, then the thing moves much more quickly.
Yeah, yeah, exactly. And I think, it's right now, it's sort of in the seller's score to, accept the realities of the current housing markets. Anecdotally, I hear that sellers still expect prices that, were relevant in spring of last year, and maybe that's just not a realistic expectation anymore.
Right, right, exactly. Interesting. Okay, so does your team at CoreLogic? We talked a little bit about mortgage rate forecasting. Do you do recession and inflation kind of forecasting? Like, do you have outlooks on what we should expect there?
No, we don't do forecasts for inflation or the recession. We do. We have a general stance on it. What we believe it's going to happen, but we don't do. We use outside sources for that.
And what is your general stance about inflation and recession for the rest of the year?
Yeah, I think in terms of the inflation, I think, clearly the more recent data showed it's very challenging. And I'm in the camp of folks that maybe they think that recession may not come down as fast as we would like it to come. I think I'm seeing inflationary pressures penetrate in other types, in larger number of services, and especially, like, one thing that really brought it to my attention was when I had to renew my auto insurance, and my auto insurance went up by some 30-40%. And mind you, I didn't do anything wrong with, I didn't get in a car accident or anything like that. So
You
that
right,
was a
right.
huge shock for me, and so, I think inflation is going to be really hard to reel back in as fast as we'd like it to, which suggests that, and continual consumer spending is going to be helping that inflation pressure remain strong, which means that recession. I don't necessarily foresee recession in this quarter, even despite all the job layoffs that we've been talking about. I mean, we follow very closely unemployment claims and just jobs in general. I mean, jobs lead to home housing demand. It's certainly not been represented in jobs data, those losses, because we do have still so many job openings out there. So I think economic conditions remain relatively strong, which means inflation will be, won't come down as fast as we'd like it to come down.
So to summarize, you have more fears on the inflation side than on the recession side this year.
Yes. Hmm.
Yeah, and that kind of implies that mortgage rates will probably stay higher this year.
Right, right. Yeah. And and this, I think my opinion on this has been sort of modified by most recent reports. And another report that I looked at was consumer spending, credit card spending, and that jumped back up in January too. So, I think the pullback that we saw at the end of 2022, may be temporary, and so that's kind of what led to my change of heart on inflation.
Yeah, I mean, it was real stark economic data several days in a row of
Right.
like, man, the economy's going strong, jobs
Yeah,
are strong, spending is strong, like all of those things, and mortgage rates responded very quickly to that.
absolutely. Yeah.
Yeah. So that's great. We talked about the CoreLogic, the mortgage application data where you can see first time homebuyers
Mhm.
ticking in.
Mhm.
Are there other things in your unique CoreLogic universe that you can see that help us understand maybe like mortgage rates today? I think are like 6.8%
Mhm.
for the 30-year fixed. And versus 6%. Like, can we see thresholds? Have you noticed things like that, or like, are there other things in the data in the CoreLogic data that we should know about?
Well, we have such a wealth of data that sometimes even internally we can get overwhelmed with, like, what data source to focus to focus on. But one data that's usually really telling, and you mentioned that data was it MLS data. If you look at the weekly activity in MLS data, you can oftentimes almost instantaneously see changes or responses to mortgage rate environment. I don't necessarily think that I can see a threshold yet. Because I think we didn't give U.S. consumers enough credit coming into 2022. I think we were already thinking that housing demand is going to weaken as mortgage rates go up, but they actually, in my opinion, remained the housing demand remained relatively strong for a relatively longer period of time in 2022 because of the strength of U.S. consumers. So, that's sort of roundabout way of thinking about that. But we do have other data. We have a lot of property record data. We have permit data. We have geospatial data. We have valuations data. We have liens data. We have ownership data. So we have a really comprehensive view of a property that's pretty unique for CoreLogic.
Yeah. Can you see, do you spend any time with the permit data?
Yeah, I have spent some time on it. I've been particularly interested in what's happening with ADUs in California, as we think about sort of alternative supply sources of supply, housing supply. And I live in California and I'm going through ADU process, adding an ADU to my property. So I've been really interested in that. So I looked at that, but then also sort of the types of green features that are being added to homes and to what extent that is accounted for in valuation of homes. And so we've done some analysis using permit data, but I'll tell you, permit data is messy, messy data.
Yeah, for sure. Do you have conclusions about ADUs? Do you have are there things that you've learned that we should know about ADUs and the alternative dwelling units? And I'm a fan, I live in my in San Francisco, right? And I'm a fan of density, and so ADUs as a form of density, is something that I'm interested in. What have you learned along the way about ADUs?
Well, ADUs, there's been a significant increase in applications for ADU permits in California ever since the SB 9 and SB 10 over the last few years. So people definitely want to add units, and they're open to it. I think um, one challenge that they're facing is, understanding financing and really actually understanding the permitting process, and also then getting the right contractor. I think the actual adding of ADUs seems to be taking much longer from the permit to completion. That period could sometimes take a long time because there is a lot of gray areas, and just average folks don't understand necessarily how to go through all of these steps, and if they don't have financing readily available, it may be challenging, maybe, kind of going in business spurs. So that's one thing. But yeah.
Yeah, and do you the financing? It's does the financing get harder this year? All of a sudden, it's a lot more expensive to finance that construction, and what does that do to the permit level, and what does it do to my view as a homeowner? One reason we want to add the ADUs is to add income to my property.
Mhm.
And so what does it do to my view of income? Was the ADU boom a function of 2.8% mortgage rates? Or does it persist even when we're sitting at 7?
Yeah, I don't know that it's necessarily a function of the mortgage rates. I think it's a function, at least in California, of that potential income, and then also just lack of supply. So lack of supply leading to ability to add the additional income to your household. But The other thing to keep in mind is that households in California, households everywhere in the nation, but especially in these more pricier areas where we've seen a lot of home price appreciation, they have a lot of home equity. And so, on average in California, home equity is at about, I think, I want to say around $500,000. And so, tapping into that has been something that a lot of folks do. We've seen an increase in HELOC authorization as a result of that, even through a second part of 2022 when mortgage rates or rates in general were increasing. So I think the income part is driving that demand for ADUs.
Yeah. So we have actually seen HELOCs kick up.
Mm-hmm.
We did see that keep increasing despite rising rates.
Yeah, we did. Mm-hmm. Absolutely.
That's that's good data to know. That's good data. You mentioned some of the green features
Mm-hmm.
of, and have you seen impact of things like solar and what that does to home valuations?
Right. So actually that part has been a little bit more harder to put a number on, simply because for a lot of folks, adding solar panels, for example, may not make financial sense because they may not be, still adding solar is expensive, right? And so depending on your utilization of your electrical, um, your electricity, it may not just work out financially to add, or it may take too long of a time to pay for the solar panels to pay off, right? So we have not seen a significant, what one say, significant impact on valuations in from solar panels. There has been some impact, but it's still not that significant. And I think it's just there's also not a lot of consistency there. And it depends on the areas that, it's more concentrated in areas that have a lot of sunshine. So other parts of the country don't necessarily have as much solar additions. So it hasn't, basically the conclusion hasn't been the result hasn't been conclusive.
Right. So the sample size is too
It's
small
small.
and
Yeah.
heterogeneous, I suppose.
Yeah.
Okay, that's interesting to know. Well, so here's one thing I'm interested in. So we talk a little bit about it, and we'll talk more about where you think we're going, and what the year looks like, and future. But one thing I like to ask my guests is, last year at this time, uh, what did you think was coming, and were there things that you got wrong or right last year at this time?
Yeah. Well, so we certainly expected mortgages to go up. We certainly expected home price appreciation to slow. And I think and home sales. Well, I think we didn't expect home sales to slow as much as they did, right? So we didn't expect that collapse in housing demand. I think in terms of the mortgage rates increase, I think at the beginning of the year, we had a forecast for maybe a 5% mortgage rates by the end of the year. Clearly much different than what
Right.
the outcome was. And I think we also didn't expect as much volatility in terms of rates. We didn't expect Ukraine, for example. I think we were expecting to come out of the pandemic with strong demand and a strong consumer outlook, but not as much of these black swan events. So we sometimes call them these unexpected events, such as Ukraine, which then had an impact on gas prices and food prices, and sort of perpetuated that inflation pressure. I think also in terms of the supply chains constraints that had an impact on inflation. So I think the outlook for inflation was also a little bit different at the beginning of last year than what it ultimately ended up being. The other thing is, coming into 2022, I recall housing market being just super, super strong. At least, bidding wars were really prominent. And I think at the time, Federal Reserve was communicating that their intent to start tightening, and as a result of that, a lot of folks jumped into the market and maybe locked in that mortgage rates, and so we're bidding home prices way over than that what we would naturally see in a typical spring home buying season. So in only first 6 months of the year, we saw 10-12% cumulative home price appreciation just in that short period of time where, on average year, we don't even see 5%. We do on average see 4 to 5%, but, that's twice as higher. So, there was a lot of, uh, in some way, exuberance and unsustainable buying behavior that was happening in 20 at the beginning of 2022.
Yeah, there sure was. So now we're looking at 2023. And have you thought about black swans that might hit us this year that might do things that might like put a stop to the housing market, as abrupt as it was last year? Or have you thought about like, are there risks on the horizon that you're thinking about?
Yeah, I mean, I think Ukraine is still a huge risk. I mean, I think day to day we are seeing things that maybe are not necessarily comfortable. Thinking long term of how the outcome of the situation is going to be. So I do worry about Ukraine. I do worry about just geopolitical risks out there. There's also weather related issues. We're going through this new set of storms coming through the country, that are going to be very detrimental to a lot of markets, across the country. So that brings me to climate change. We've been spending a lot of time thinking about climate change and spending a lot of time developing data sets to allow us to understand climate change impacts. I think every year we come across more and more events that are very, that destroy a lot of homes, that make people lose their shelter. And so, that's always one that you cannot, you sort of know it's been getting worse, but you don't know, what that catastrophic event may be, that black swan event, for example. So that's another one. Um, but so
Well,
I
let me
think
ask you this.
okay.
I'm interested. I'm definitely interested in your conclusions about climate change, but I have a question on Ukraine and geopolitical risk. How do you see that translates into risk for the U.S. housing market? What's the mechanism there?
Right. So, well, we could have persistent inflation pressures, right? Which then, say if we have continued supply chain disruptions, or even new supply chain disruptions, or gas prices go back up, or food prices increase again, or for some reason, that leads to inflation pressures. And so inflation pressures then, leads to stronger tightening by Federal Reserve, and that leads to higher mortgage rates. So that's one of the ways of doing that. The other one is just general consumer confidence. People at times of uncertainty tend to pull back and choose to to wait out on the sidelines, which is something we've seen over the last at least 6 months. And so, consumers not having that confidence that things are going to be all right, is not good for the housing market. And consumers, based on the University of Michigan consumer sentiment, the sentiment whether it's a good time to buy or sell, is both went in a negative direction since mortgage rates went up last year, and so consumers seem to be waiting for something, and then if you add more uncertainty and these geopolitical risks to that, I don't think that bodes well.
That makes a lot of sense. Thank you for that insight. So let's talk about your work with climate change, climate risk, and the impact. Any conclusions that you've been able to draw, or themes that you're following in with relation to climate change?
Yeah, we're still at the beginning of this research. We're still developing sort of our research agenda, but we do think it's a very important research agenda. We just came out with a climate risk analytics a platform, and so that there's a model, a climate model that combines all of these data sets that we have, and then that helps us predict the climate impact on properties and regions. And so what we did find is that regions that do have persistent natural hazards like hurricanes, wildfires, there is a long-term impact on home prices. And so some parts of Florida, for example, particularly not necessarily, when you think about a hurricane per se, but then flash floods that result from hurricanes, and areas that are in, more lower laying areas, more exposed to that flash flood, we do see an impact on home prices. Similarly, on the West Coast, when you look at the Northern California and, areas that have seen consistent or persistent wildfires, we do see now a resultant impact on a rate of home price appreciation being slower than what is, say regionally or nationally. So there is already that impact on home prices being accounted for as a result of climate risks.
That's really fascinating. Do you guys use that in your insurance business? Like, is that data, is it going into the insurance business or coming out of the insurance side of the?
Right. It's both ways, right? They both feed each other, but yes.
Yeah. Yeah. The flood and fire is like, I think about that a lot. And the, it feels to me like we are, we're underpricing risk in much of the country, underpricing climate risk.
Yeah, no, absolutely. And, I started off talking about how I was looking at how metropolitan areas change and, spatial distribution of metropolitan area and, where people move to and leave from. And, I think certainly seeing how much home demand has gone into some of these very much higher risk areas, it's going to be interesting to observe going forward how the demand may potentially shift, and people may be moving to areas that, or maybe at least accounting for that risk in their home purchase decision or in the pricing of the properties.
Right, 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 right. Interesting. And on that spatial theme where people are moving,
Mm-hmm.
have you done any work or you done any thinking on the remote work and the work from home trend and where that goes next?
Yeah, so that's a really interesting one because a lot of the trends that happened during the pandemic actually were trends that started even prior to the pandemic, right? So people were already sort of seeking more affordable regions. They were already moving to some parts of the countries that were more affordable, and that trend just got exacerbated during the pandemic. But even now, sort of if you think somewhat of a post-pandemic. I mean, 2022 was not fully post-pandemic, but at least it wasn't in at the height of those closures. Um, we continue to see same migration trends that we saw during the pandemic and even prior to the pandemic to some extent. And so let me explain that a little bit better. So at least in terms of people moving to more affordable parts of the country, like Southeast, Florida being one of them, Texas, Carolinas, Georgia, Tennessee, we do continue to see out migration to those areas from more expensive Northeast and some Midwest areas. The situation on the West Coast is a little bit different because we had in, an elevated rate of migration during the pandemic to more affordable mountain west states like Idaho, Nevada, Arizona, Wyoming, and that's where home price appreciation at the peak of the pandemic was the highest. But now these are the areas that see largest decline in home prices since the peak of last year, because some of those folks are either coming back or we are not seeing as much migration in those areas. So the local folks that are in those areas are in no way able to afford the price levels that these folks that were coming in were able to bid up prices too. So home prices in those areas are coming down. But that's not to say that people are not going to stop moving. That they're now going to stop moving there. They're just not moving at the same rate that they used to. And then by the same token, like suburban urban, relationship, we did see a lot of outmigration to suburban areas during the pandemic, which was something also that we did see prior to the pandemic, because of affordability, because of more space, because of millennials aging into those years where they want more space and have, their own households with kids and so on and so forth. But now at this point, we do see some of that reversal. People or younger folks, at least, coming back into the urban areas, central cities, and so it's not that whole migration pattern. It's a very complicated story. There are some wider patterns or wider regional patterns, but then it also depends very much locally as well.
Yeah, and so it is the Boise boom in home prices was fundamentally different from the Tampa boom.
Yes, exactly.
Interesting. For sure, we could see a boom and bust much quicker in Boise.
Mm-hmm.
That's really cool. I guess a couple more thoughts as we approach an hour here. One thing I'm interested in is your view of the longer term future of housing. There's some long term trends, like we have most folks thinks we underbuilt in the last decade, new construction. I don't know if you concur with that or if some folks have a different view.
Mm-hmm.
And then what happens next? So what happens in the next, 4, 8, 6, 10 years? What's your view of the big trends?
Right. I mean, I do definitely agree that we are undersupplied. We would not see the rate of home appreciation that we did see if we had more inventory. But on the other hand, I think that lack of inventory is helping, keep prices, keep floor under the prices at this point right now. But I do think that there's some interesting developments out there. We talked about ADUs. I think there's been more space, more talk about like modular homes or even panel housing or conversion of office spaces. You mentioned the demand for offices earlier, and we don't do forecasts for that, but I've read some analysis out there. They're projecting quite significant declines in demand for office space, and so now there is that opportunity. Though I understand there's a lot of it's not as easy as just converting the space. The space was built differently and configured differently. That's not that easy to convert it to residential, but it's something that we are now at least talking about. So I think there are more opportunities for new types of supply out there, and I do think that there is going to be more inventory coming on the market. I think we're going through a rough period, but inventory situation will slowly improve. The other thing is it's also a regional story again. Not all markets are undersupplied. Markets in Texas, for example, they have a lot of new construction. Markets in Southeast do have also a lot of new constructions, but maybe not markets on the West Coast, markets in Mountain West, not as much. So there is a regional story there again as well. The other thing is.
Yeah, keep going.
Yeah, no, it's just things that are on my mind for a longer term future. So investor activity has been very interesting. Over the last couple of the years, we've seen elevated rate of investor activity, and that was surprising to see. Persistent investor activity, even when mortgage rates went up. Even though we know that they, maybe purchasing with cash or alternative source, they're not so dependent on mortgage rates per se, but share of small investors has actually increased and has remained elevated. So that's the part that's interesting to me. And so then it begs the question of what happens with homeownership opportunities for these younger folks or folks that don't necessarily have generational wealth transfer, right? So that's something that is on my radar for sure going forward. We talked about equity, how much equity people have, and just now what are baby boomers, for example, because those are the folks with the largest amount of accumulated home equity. What are they going to do with that equity? How are they going to extract that equity? And maybe to what degree they're going to be adding supply by adding these additional units. Maybe, this is not just the case in California, but I had a conversation with somebody in Atlanta who has a large property and now doesn't want to give up the property because of the low mortgage rate and all these things that we've been discussing. But he's thinking about adding additional units to his property and maybe even splitting up his lot because it's a large lot to add more new housing. So there's some exciting things to look forward to going forward, I think.
There's a lot there about the long-term future. One thread I want to pull on is you said you do anticipate greater inventory coming in the future. And tell me what the mechanisms you think are going to contribute to that greater inventory. And do you think that's like this year? Is that multi-year horizon on that?
It's a multi-year horizon, and I think we have to remember where in terms of new construction, where we came from, right? We had the great building boom prior to Great Recession, and then the new construction fell to historical lows and was trending at about 50% of what we would be needing, looking at our population and household growth. And so it's been slowly inching up to what we need. And so we've now we've now reached that level of new construction that at least we are adding some new units relative to how much we do need, population growth and household growth. So I do hope that we do move in positive direction from here on out. And one reason is, we're past the pandemic, so we do see a new increase in international migration. International migration is very helpful for the construction industry, because we do have huge labor shortages in that industry. The other thing is, we are talking about, there's a lot of the administration is currently doing to incentivize these alternative sources of new construction, such as modular homes or panel construction and things like that. There's a lot of innovation going on in that space. And I think the other thing is people have all this equity that we talked about. So that is a new source of funding too. So I think all of these factors combined are telling me that, we're going to see some relief in terms of the inventory.
Okay, that's good. So you think it comes from new construction. I like the innovation angle of it. I think there's a lot to happen there too. That's exciting.
Yeah.
And that we have financing to do it. Because we have equity there. Those are fundamentally optimistic. I like those. I like that view. Okay. Well, look, we are right at the top of our hour. What's the best way for folks to follow your work, like social media? What do you publish at CoreLogic? Where should they find you?
Yeah, so we have our CoreLogic website, CoreLogic.com. On our website, we do have an intelligence page. So if you go to CoreLogic.com and then you go under resources, there's a number of reports there. There's insights blogs. I write and I share on my social media under Selma Hepp. But there's a lot of really, really intelligent and very deep thinkers in CoreLogic who do a lot of their own writing. So I would suggest to at least look at our webpage and look at some of those writings as well. But I do post a lot on LinkedIn. That's kind of my main source of social media. I have a little bit of love-hate relationship with Twitter, but right.
Yeah. But people can follow you on LinkedIn.
Yes, LinkedIn.
And watch your work there, and so that's terrific. And the power of the CoreLogic data set and the reach in the industry that you have is really terrific. And really congratulations on the new role as the chief economist for CoreLogic. That's a really neat position to be able to get. So congratulations on that.
I appreciate it. Thank you so much.
All right, Selma Hepp, thank you so much for joining us today. Everybody, this is the Top of Mind podcast. I'm Mike Simonsen. I'm the founder of Altos Research. And thanks for joining us this week. We'll be back. We'll have another guest next week. All right, everybody, thanks. Thanks for listening to Top of Mind. If you enjoyed the show, I'd really appreciate leaving a nice review on your favorite podcast app. That helps other people find us as well. Be sure to subscribe so you don't miss future episodes. See you soon.